Good evening, everybody. Thanks so much for coming. I know it's not that pleasant out there, and I appreciate all of you bearing with us, having to close the library last week because of the severe weather that we experienced, and I appreciate that you all made it here tonight, and we are very lucky that we had a room available. We were holding it in case we had a special election. That's the only reason we have something open tonight. And we really appreciate Patty being flexible as well. Please welcome attorney and business tax expert Patricia Ritzert of the Cleveland firm of Climaco, Wilcox, Peca, Tarantino, and Garofoli, L.P.A. She has 30 years of legal experience. She has a bachelor's in economics, as well as 2 post-Juris Doctor degrees, a master's in tax accounting from the University of Akron, and an LLM in taxation from Case Western Reserve's University School of Law. She's been a presenter at the Cleveland Tax Institute, and for 7 years she's been an adjunct professor of law at the Cleveland Marshall School of Law at Cleveland State University. So we have a real expert here. And we are very happy to have her. Let's give her a warm welcome.
Thank you. Thank you very much. I'm not used to using a microphone, so let me know if you can't hear me. Okay, for this information session and workshop, I looked at some of the evaluations from past presentations and formed my outline around what it seemed that people who attended past presentations were looking for and what they wanted. So the outline for this presentation is actually on here. We have different forms of doing business. And I am making some assumptions here that I will share with you because they run throughout the presentation. One of the assumptions is that people who are attending here tonight are probably interested in running or are running a small business, meaning that it has receipts less than $10 million a year, and that the ownership of the business within no more than 2 levels above you is in the hands of individuals, that you're not running businesses where the partners are other partnerships or corporations. So I'm going to talk about the basic forms of doing business, which are the sole proprietorship, the partnership, the corporation, the Subchapter S Corporation, and the Ohio Limited Liability Company. A sole proprietorship is a person who works and makes money, but works for themselves. A partnership is really the same thing, except that it involves 2 people. A partnership is 2 people working at the same business enterprise and sharing the risks of the business, as well as sharing the profits of the business and the losses of the business to one extent or another. It doesn't have to be equal. Partnerships can be very unequal. Partners can contribute cash, can contribute property, like in the form of equipment or building space or land, or can contribute their own services to a partnership, and it is no less a partnership. A corporation is a special entity because you can only become a corporation by following the rules of some state or the United States. So to form an association that is recognized as a corporation, you have to follow certain rules, file paperwork, and be registered in Ohio, for example, with the Secretary of State. These descriptions that I'm giving hold true for the tax treatment of these entities as well. But I'll get back to that. The Subchapter S corporation is a tax creature. A Subchapter S corporation is first a corporation. It can choose to be taxed under special rules that eliminate the double taxation in large part. An Ohio limited liability company is, or was when it was first created, really meant to be the holy grail, because a limited liability company is an entity that under tax law can be taxed as a partnership, while under state law it has all the limited liability that corporate shareholders are entitled to. The two poles of the spectrum here are the partnership and the corporation. The partnership is a group of individuals who are taxed based on the profits of their joint enterprise, but the enterprise itself pays no tax. At the opposite end of the spectrum is the corporation, where the corporation is a separate tax-paying entity, as if it were a person. In fact, the word person under the tax law includes entities like a corporation. You know, if they want to talk about a human being, they say individual. So person and individual are two different things under tax law. Okay. A sole proprietorship typically has a single owner. The business income, the expenses, and the transactions, and this is for tax reporting purposes, of course, should be tracked as if that business were a separate entity, so that you have an account that tracks only the business income. You keep track of business expenses, for example, for using a personal vehicle or any vehicle that might be used partly for business and partly for personal use. There should be a written log kept of the number of miles driven for business purposes, the number of miles driven for personal purposes, and the IRS even asks you on the reporting form whether you maintained a written record of personal use of a vehicle. But it's not just the vehicle. All the personal and business expenses should be kept separate. The fact is, no, they don't have to be until you're audited. And then when you're audited, you want to be able to prove it. So it's by far a better practice to keep your business and personal expenses well accounted for separately. Many people who operate a sole proprietorship, at least at some point in their sole proprietorship career, have an office in the house, in their home. And there is something called a home office deduction, which has at times gotten very complicated, where you measure all different things, like keep track of all of your utilities and then figure out what percentage was attributable to the business use of the home, what percentage of your trash pickup was attributable to the business use. And it got very complicated, and people were being audited on deducting home office expenses. This year, it was in 2013, but just in 2013, the IRS put into place some rules that make it simpler. So I summarized them briefly, and they're in your materials. They created what they call a safe harbor. Under the tax code, there are a number of situations where the IRS has defined a safe harbor. And what that means is that if you follow the rules that they set out as a safe harbor, they won't bother you. If you fall outside of the safe harbor, you might be in choppy waters, but it doesn't mean you're sunk. It just means that you haven't taken the ultra-safe path of following the rules for the safe harbor. So the safe harbor is that a taxpayer can determine how much to deduct for the business use of their home by multiplying a given rate by the square footage of the residence that they use for business purposes. So the current rate is $5 a square foot. Now that's prescribed by regulations. That can be increased when there's inflation. The allowable square footage is limited to 300 square feet. So up to 300 square feet can be deducted at the rate of $5 a square foot. And of course, it has to be supported. You have to actually use the whole 300 square feet. You might fall into the safe harbor one year and the next year decide that because of maybe certain particular repairs that had to be made to the part of the home that was used only for business, you would come out better if you did a specific tracing of expenses to the business use of the home. So you wouldn't have to follow the safe harbor every year. If you use the safe harbor, then you no longer deduct and track all of the individual expenses. You don't figure out what percentage of your utilities to deduct and what percent of your trash pickup costs, what percent of your insurance, what amount to depreciate. You don't have to do all of that. You can just do the straight $5 a square foot. The full safe harbor is in the, right here. If you even Google that, you'll get Revenue Ruling 2013-13, and that's where all of these rules are explained. And it's not overly long, and it's not overly complicated. But that last paragraph, that's not new. As always, you're not allowed to deduct more for the business use of your home than the money you made using it. So you're not allowed to create a loss for yourself through a home office deduction. Okay. How do you report your income if you're a sole proprietorship? You use Schedule C, which is a part of your regular Form 1040. How many people here have filed a Schedule C in the past? Okay, good. We have a 1040 and a Schedule C in the information that's here, and I can go to those on this screen. First, I want to look at the Schedule C. There we go. The Schedule C is really not all that complicated. After the identifying information at the top, you have two major sections. The first one is right down there at the bottom of the screen. It's the income. Gross receipts, less returns and allowances, cost of goods, et cetera. And then the second part is the expenses that are deducted from that income. And the form suggests several categories of expenses, but that you're not limited to those. There's a line for additional expenses. And there's a line here for expenses for, well, there it is, expenses for business use of the home. They ask an interesting question on here, though. No, I'm wrong. This isn't the form that has the question I was thinking of. But there are questions about business use of the home, square footage. The next page, or the other side of this form, requires you to track inventory if you have a business that uses inventory, and additional costs. So it's not a complicated form. This information on the back is going to end up being transferred back onto the front, and your net profit on the front. Here, total other expenses. Oh, we're still on the back. I have to go back to the. There we are. Okay. You will end up on line 31 with a net profit or loss. Where does that go? Where that goes is on your 1040. But not there. Should be around line 12. But that's how it meshes in with your personal tax situation. You figure out through separate accounting, you know what you've made in your sole proprietorship. On line 12, you include the net profit or loss from the Schedule C, and it will end up being taxed as ordinary income together with any other income that's reported on your 1040. However, you have the privilege of paying self-employment tax, which substitutes for the Social Security and Medicare tax that is withheld for individuals who are employed. So I think I've covered everything that's on this slide. Taxed as part of personal income with the additional requirement of self-employment tax at 15.3%, which is the total of the Social Security and Medicare tax. The tax rates, I put this in here because not very many people realize that in that whole tax code, which is, that thick, there's a single section that actually imposes the tax, and it's Section 1 of the tax code. And most of the rest of the code is details and exceptions. But for a sole proprietor, the tax is imposed right here in Section 1, as on everybody, not just sole proprietors. A tax is hereby imposed on married individuals filing joint returns and surviving spouses. And then this is the tax table as it's set forth by Congress. The Secretary of the Treasury has the power to adjust the tables every year. The next section imposes a tax on heads of households. There is hereby imposed on the taxable income of every head of a household at those rates. The next section, unmarried individuals filing separately. I didn't do the whole section. I stopped after this one. There's another section for married individuals filing separately. There is hereby imposed on the taxable income of every individual a tax determined according to the following table. And there's that one. There at the bottom, you obviously can't click on it, but that would take you to the inflation-adjusted tables for this year. So that's how a sole proprietorship gets taxed. If you're tired of operating alone and someone else joins you in your business and you work together at the same enterprise to share profits and losses and risk, then you're a partnership. A partnership is formed in a less formal way than a corporation. I told you you can't be a corporation without following a number of state law rules. Well, you can be a partnership by simply forming an agreement with another person to operate a partnership. The partnership can even come into being without your expressly deciding that that's what you're doing. So the governing document for a partnership is the partnership agreement, and that's true under both state law and for purposes of tax law. Under tax law, however, it includes your written agreement, your oral understandings, your practices and ways of doing things, and it includes the state law responsibilities that are put on you. Many of you are aware that a general partner is liable for the debts of a business. That is what people have been trying to avoid for ages. So limited partnerships came into being, where there could be limited partners who were not responsible for debts of the business, but there would always remain one general partner. Then we created limited liability, limited partnerships, and for tax purposes, though, there is just tax on a sole proprietor, tax on a partnership, and tax on a corporation, which we'll get to in a few minutes. The form of partnership doesn't matter. It's the same scheme of taxation that applies. There's a lot of latitude for partners to define their interests in the assets, income, deductions, losses, etc. For example, I might be in partnership with the woman in purple in the front row. She might be allowed to deduct 90% of the losses while we split the income 50-50. That's allowed. The partners can share items in any number of proportions. A partner might be allocated 50% of the cash flow, but only 30% of the profits. But it's called pass-through taxation. The partnership itself is not a tax-paying entity. And what I've got set out under that statement here is the actual language in contrast to what you saw for the tax on individuals. This is the actual language that says a partnership as such shall not be subject to the income tax imposed in this chapter. So partnerships are not tax-paying entities. The next sentence, which is also a part of the law as passed by Congress, persons carrying on business as partners shall be liable for income tax only in their separate or individual capacities. The most difficult abstract thing to get through your head with partnership taxation, though, is this. What gets passed through is the tax effect of the income or loss or deductions. It doesn't mean that you're necessarily getting the cash from the partnership. Go to the next slide. How does this happen? How does it work that the tax effect gets passed through to the partners? Well, it's through how the tax forms are set up. A partnership is not a tax-paying entity, but it does calculate its income on a tax form. The form is Form 1065, and you should have one of those in your packet. And attached to the Form 1065 will be another schedule. It's not a Schedule C, it's called a Schedule K1. Let me get that up on the screen. And if there are any questions, stop me, ask questions. Okay, I'm just going to keep them both here minimized so I can. All right. The partnership return, again, after the identifying information at the top, has two major parts. Lines 1A through 8 track income. Lines 9 through 20 record deductions from income. And they're given categories, but as someone in the IRS once pointed out to me, the forms are written to fit the majority of situations. And when you have a situation that just doesn't seem to fit on the form, make an attachment. So, or use the extra lines on the back of the form. So, it's just a general hint. So that's the basic calculation on here. However, with partnerships, not only does the bottom line get passed through, but the tax effect of individual items of income gets passed through. Anybody aware of the difference between capital gains and ordinary income? Well, ordinary income is tax language for what you earn with your own efforts. It's wages, or it's the profits of a business where you perform services, or produce and sell goods, or buy and sell goods, or broker items. That all gives rise to what's called ordinary income. Ordinary income is taxed at those rates that I showed you for a sole proprietor. That's the tax on individual single people and married people and heads of households. Capital gains are profits that you make from buying and selling property. Capital gains are currently taxed at a special lower rate than ordinary income. When a partnership earns ordinary income, that is reported on the front page of the 1065 that we just looked at. But when a partnership earns capital gains by selling some of its property or equipment, not inventory, but manufacturing equipment or something that was used in the business. When a partnership earns capital gains, those also are passed through, at least in tax effect, to the partners. They might not get a cut of the actual gain that was produced. They don't necessarily get the cash. Tax law doesn't cover that. Tax law covers how we're taxed on it. So capital gains are reported separately on this form, together with a number of other items. Now, there's some information reporting on the next page, and I'm just going to flip past that. A lot of information reporting. Now, here's where we get to the partner's shares, okay? Here is where the items are separated out by type of, or as they would say in the tax law, by character of income or character of deduction or type of credit, for example. Let's say you've got 3 items. Ordinary business income, that's from, I can point with this, that's from your line 1, page 1, line 22, the page 1 that we looked at first that had income and expenses and deductions. But let's say there were other special types of income. For example, down here, either short-term capital gains or long-term capital gains. Those are separated out and stated separately. Ordinary dividends and qualified dividends are stated separately. The reason for that is because how they are treated can depend on the tax situation of the individual partner. 179 deduction, that's stated separately. Charitable contributions are stated separately. That's because the individual partners have their own limits on how much they can deduct for charitable contributions. Okay, that's enough. After listing all of those separate items on this form, a new balance sheet is prepared for, and the partners' capital accounts are stated, but we're not, that's too much in the weeds for our purposes today. What I want to show you is how the tax effect gets passed through to the partners. This is how it works. All of these items on this page that are separately stated, whoops, it was this page, that were separately stated, and I'm going to reduce this in size a little bit so we can see more of it at once. Okay. All of these items now need to be broken out per partner. They are broken out per partner and reported on each partner's individual K-1. This is the other form that I mentioned. This form, this schedule, is prepared, one for each partner in the partnership. The partnership is identified in Part 1. Part 2, here, identifies the partner. The type of partnership is identified. The partner's share, you can't see me point. I'm pointing at the screen. I'm thinking you can see it. Here, the partner's shares are identified. What is the breakdown? How much of what percentage of profits is this partner entitled to? What percentage of the losses is this partner entitled to? And if this partnership were to liquidate right now today and sell everything and divide the money and everybody walks away, that would be the share of capital that a partner would get if they were to liquidate today. So the individual partner's capital account is listed here, which is actually, should be, the amount of money that that partner would be entitled to if the partnership liquidated. But he's not taxed on that. What he's taxed on is all those individual separately stated items. The items on Schedule K in the 1065, which I just closed out of, are broken out per partner, and those same items are put in Part 3 on the appropriate line to identify the partner's share of each one of those items. So this partner, for example, might share 50% of $100,000 profit. So their share would be reported to them on this line. Let's say that the company earned a little bit of interest income, say $100 on a savings account, and this partner is a 50-50 partner, so this partner is entitled to $50 of the $100 in interest, at least in tax effect. If this company sold collectibles and had a gain on them, there's a special tax rate applicable to that. So those are separately stated. If $1,200 was the profit on collectibles, and let's say that the partnership agreement only gave this partner, who didn't contribute the collectibles to the partnership, only a 30% interest in the profits on the sale of collectibles. Well, let's say there was $100 in profit, 30% would be $30 that would be allocable to this particular partner. There are in the tax code, there's a relatively short list of these separately stated items, and that's what they're referred to in the tax code as separately stated items. There's room for other on here, room for 179 deductions. Those are deductions you can take for up to $25,000 worth, or depending on the year, or $100,000 worth of equipment without having to depreciate it. You can just write it off under Section 179. That gets divided out per partner. Okay. In addition to those separately stated items that you just saw on the front of Schedule K1, the Secretary of the Treasury has the power and the authority to identify other separately stated items that have to be specifically allocated among the partners. And you've got a whole slew of what the Secretary has added to the list on the back of the K1. Look at all that. Fortunately, hardly anybody has, nobody has all of them at once. And it's no secret that tax accounting can get a little complicated. But that's how it works. That's how the tax effect of the operations of the partnership get passed through to the partners. It's by the K1, yes.
In the K1, obviously you should report all the net profit that you're receiving. Is there any?
Well, here's the thing. Under the partnership scheme of taxation, you're being taxed at only one level. That is at the level of the individual partner. You'll see in a minute that with a corporation, there are 2 layers of tax, which you avoid by being in a partnership. But the payback for avoiding that second layer of taxation is you pay the tax whether the money is distributed to you or not. So you might be getting a draw from the partnership, but if at the end of the year the partnership has actually lost money, they just converted enough to cash that you could take your draw out, then you're going to show a loss on your partnership return or on your K1. You're going to be reported a loss, and that'll get transferred to your 1040. I don't know if I answered your question. Okay. Any other questions? Okay. That question led nicely into an example that I prepared that I will go to. Will this go back to where we were? Yes. Oh, good. No, it didn't. Okay. I just showed you the K1. There are pass-through items. There are a number of separately stated items. And then there's one example of a type of deduction, charitable contributions. You can't deduct more than 50% of your income for charitable contributions. I never got close. That's a high limit if you ask me. But there is a limit on how much you can deduct in charitable contributions. So those are passed through by being reported on the K1, and the partners then have to compare that contribution to the rest of their charitable contributions and determine whether they fall under the limit for deducting charitable contributions. So that's why it must be separately stated. Okay, let's move on. We looked at 1065. We looked at the K1. We noted the separately stated items. There are limits on what you can deduct as a loss from a partnership. The first limit is your basis in the partnership interest. Are you familiar with, how many of you are familiar with the concept of tax basis? Okay, think of it as what you have invested in the business that has already been taxed in some other way. For example, if you have savings from earning salary savings and you invest that into the partnership, well, that's not going to get taxed again. That becomes your basis. But that basis can be increased by the earnings of the partnership. It can be increased when you borrow money on behalf of the partnership. And I'm not going to go any more into that. It's just a concept, though, that eventually you would want to become familiar with. So there are certain limitations on the losses you can take as a partner in a business. But in a business where you are doing, you're actively involved, I would say you wouldn't really need to worry about too many of these limitations because they apply in most situations to people who are limited partners that don't actively participate in the business. The partners who act more as investors rather than run the business day to day. Okay. I think we already covered that first point. Yep, I mentioned the trade-off. Only taxed at one level, but that means you have to pay tax every year as long as there's income that year, net income. Okay, this contrasts to the corporate scheme in which the dividends paid by a corporation to a shareholder are not taxed until the dividends are declared and paid. If you own shares of stock in GM, and thank goodness we can still use GM again as an example. For a while, we kind of wondered whether GM could be the classic example of a widely held corporation. If you hold stock in GM, you might be paid a dividend, but GM might have earned billions and billions more dollars than the dividends that it pays out. But you, as a stockholder, only pay tax on the dividend that's reported to you and that you actually receive. So you don't have to pay tax on all of the profits every year, but, as I'll show you in a minute, you're burned by the double tax system. Losses being passed through for tax purposes are a good thing. Losses are a good thing because you can use them to shelter other income. I know it feels like you're losing money when there's a loss passed through from a partnership. And on startup, there often are losses. But when those losses can be used to zero out or reduce the taxable income from maybe a second job, then they're valuable. Okay, I think we covered this. So the next I was going to get into is corporations, but I'm going to go to that example that I wanted to show you, the effect that the double tax system has and how it's better under a partnership system that has only a single level of taxation. Let me go to the example. There we go. Here's our example. Susan and Zeke, two single cash method taxpayers, interested in beginning a new bicycle manufacturing business. The business, which Susan and Zeke will call Bikes Corp., is expected to produce about $1 million of taxable income per year. That would be net profits because it's the taxable income. That's after the deductions. Assuming that Bikes is formed as a C corporation, which we'll discuss in a minute, but that's your state law corporation. Let's figure its income tax liability on $1 million of taxable income under Section 11 of the tax code. Okay, we can jump back and look at Section 11, which is there. This is like Section 1, only it's the section that taxes corporations. A tax is hereby imposed for each tax year on the taxable income of every corporation. And then there's the tax rates. 15% up to $50,000, 25% of the next $25,000, taking you up to $75,000, and then 34% of the income that exceeds $75,000 up to $10 million. Once you get to $10 million, you pay 35%. Okay, this is as passed by Congress. Again, it's subject to adjustment by the Internal Revenue Service. Then there's this extra surtax that appears in the flush language below D. In the case of a corporation which has taxable income above $100,000, the amount of tax determined under this section shall be increased by the lesser of 5% of the excess over $100,000, or a flat number of $11,750. And then I'm not going to worry about the rest of it because we just read all we need to do to go through that example. So those are the corporate tax rates. So Susan and Zeke, we hypothesize, are going to earn $1 million of taxable income. Well, the first $50,000 is taxed at 15%. That's $7,500. The next $25,000 is taxed at 25%. That's $6,250. The next $925,000 is taxed at 34%. $314,500. So the corporation, as a separate taxpayer, as if it were a person in its own right, will pay a tax of $328,250, subject to that flush language that contains a surtax. The surtax was the lesser of 5% of the excess over $100,000, or $11,750. Well, 5% of $900,000 is $45,000. So clearly, the lesser amount is the $11,750. So we can ignore the $45,000. We only need to use the $11,750. That's our surtax under that flush language in the code section. The surtax brings the tax bill for Bikes Corp. From $328,250 to $340,000. That's the corporate tax. You'll notice that this is really a flat 34%. It ends up being that after you add the surtax, you're paying that 34% on all of the income. That's the purpose of the surtax. It basically eliminates the benefit of the 15% rate and the 25% rate for anyone who makes over a certain amount. And that certain amount is somewhere between $500,000 and $1 million. I don't remember where it is. Okay. If Bikes Corporation now distributes the rest of its profit to the shareholders as dividends, because this is a corporation and stockholders earn dividends, what will be the result? Well, okay, we had $1 million. We have to pay $340,000 in tax. That means that what's left is $660,000, right? So this was profit, remember. So let's pay a dividend to our stockholders of $330,000 each and let them take that cash home. Well, that is dividend income to the shareholders. That is going to have to be reported on their Schedule B of their Form 1040. When they put it on their Form 1040, since it is qualified dividends, which are basically domestic corporations' dividends, it has a tax rate given in that first paragraph up there of only 20%. 20% on qualified dividends. They're paying 40% on their ordinary income. And for simplicity, this tax rate that we're hypothesizing here is a blended rate. It's federal and state taxes all rolled up together. So, okay. On $330,000 each, they will each pay 20% in tax. 20% of the 660 altogether is going to be 20% of the dividend income will be $130,000. So, Bikes Corp paid a tax of $340,000. Susan and Zeke together pay a tax of $130,000. Our total is $472,000 in taxes paid by the shareholders and the corporation together on $1 million. That leaves $528,000 out of $1 million for the shareholders to spend on themselves. So that's the result of the two layers of tax, one at the corporate level and another tax at the shareholder level. Flip it over and pretend this is a partnership. The partnership pays no tax at the business entity level. If Bikes is a partnership, then Susan and Zeke will each pay ordinary income tax on the profits of the business. With $1 million in clear profit, the K1 for Susan and the K1 for Zeke, and I can go back to that. They're each going to have $500,000 there in box number 1, ordinary business income, $500,000. That gets transferred to their personal Form 1040. Well, it's going to be on Schedule E, and then it's going to get transferred. I'm not going to go through all that. But it will show up on their 1040, and oh, why does it keep doing that?
Went to the first slide instead of go back to the first slide instead of going back to where you were.
Okay. Okay. Okay, so they each have $500,000 to report on their 1040. The ordinary income tax rate will now apply because this is not dividend income now. This is ordinary income. It's taxed at our pretend rate of 40%, state and federal tax together. So together, Susan and Zeke will have a tax bill of $200,000 each, or a total of $400,000. So this combined tax bill with no tax at the entity level saves $72,000. So let's go back and look at corporate taxation. That's the section that imposes the tax. We already looked at it. Corporations deduct their losses and recognize their income for tax purposes without passing them through to their stockholders. And I mean in tax effect. They get passed through to stockholders. Income gets passed through as dividends, but the tax effect is entirely different. The owners of a corporation could also be employees of the corporation. They could be creditors of the corporation, but I'm only talking about their status as stockholders when we're discussing the tax effect of business owners here. So stockholders are responsible to pay the tax on corporate earnings only to the extent that those earnings are paid to them as dividends. There are exceptions, but we're not going to go into those. Payments to the stockholders in their capacity as stockholders, not as employees or creditors, will be treated as dividends to the extent of the earnings and profits of the corporation. If it didn't have any earnings and profits, it could still pay a dividend, but it wouldn't be taxable as a dividend. And that's an odd situation that we don't need to get into here either. We already looked at the example of the effect of double taxation. So the tax reporting for the corporation does not depend on the tax situation of the shareholders, like partnerships did, and the tax situation of the partners doesn't affect the tax situation of the corporation. It's just completely separate entities.
So the trade-off then is really your exposure to your liability?
There is a trade-off in exposure to liability and a trade-off in timing. Shareholders of a corporation only pay tax when the dividends are paid. Okay, so it's not like a partnership where you could be liable for income, but all the profits end up being bound. They could be all tied up in inventory. You know, you might have a lot of inventory left at the end of the year, and that's where all your cash is. So even though you made a profit, you turned it into inventory, and you don't have cash to pay out. I mean, in real life, you would do much better cash planning than that, but that it could happen from a tax perspective. Yes.
Well, it seems to me you could also, if you've got just a few members of the corporation, if they took the fat of the corporation as employees rather than stockholders, and they accumulate the same benefits as for the partners.
That's exactly correct. And that will work as long as the wages or salary that's paid to the owners doesn't become unreasonable. Why does IRS care? I'll tell you why they care. You're thinking, well, either way, it gets taxed because they have to pay ordinary income on. Dividends are not a deduction to a corporation. Salaries are a cost of doing business. Salaries are deductible. They're a deductible expense. So salaries to a reasonable level of compensation for the work being done are a legitimate deduction for the corporation, and the gentleman is correct. An owner could also be an employee and could receive much of the profits of a corporation, especially a service corporation, in the form of salary. And that will work as long as the salary compensation doesn't become unreasonable. If it becomes unreasonable, in an audit, the IRS has the power and the authority to recharacterize the income and deny the corporation the deduction for unreasonable salaries and impose or assess a tax on the corporation after disallowing the deduction. Yes?
What's considered unreasonable?
Well, what's reasonable depends entirely on it depends on several factors. The type of business, what is paid to other people who do the same kind of work, in the same kind of market and in the same, or similar situation. I mean, someone could be called a manager, and in one business, that might be a really easy job, and in another business, what you call a manager might be an extremely responsible position, running all aspects of the business. So it's not the title that matters, but the work that's being done. If you were working as a carpenter, as an employee for a corporation, you would look at the salaries of other carpenters doing similar work in a similar market. If you're a CEO of a multi-billion-dollar international corporation, then IRS would look at salaries and compensation paid to CEOs of similar companies. So it depends. That's published? Oh, there are many, many published schedules of the Department of Labor actually publishes schedules of expected salaries or compensation for all kinds of different jobs. And in fact, the IRS uses those. If you were really interested, I could show you some cases where in court, the IRS used Department of Labor statistics to establish what it felt was reasonable compensation for a given job. And it's on the internet. You can find all kinds of schedules for reasonable compensation put out by the Department of Labor. Okay. I told you the IRS has the authority to recharacterize payments to stockholders if, for example, the compensation paid is excessive or unreasonable. So when I say this income, I don't mean the unreasonable income, but the dividend income is included on Schedule B of your 1040. I know a lot of people don't ever actually see the forms because they're using computerized programs, but it really, if you walk through it on paper, it helps you understand the situation much more easily. I know I opened the B already. There it is. Interest and dividends go on Schedule B. First one's interest. There are the dividends. Dividends are reported on Schedule B. You get a 1099 DIV that reports the dividends to you. Okay, now I have to try and go back to it without. If I go to slideshow.
Slideshow, and then from current slide on the left.
Okay. All right. Let's move on. Oh, well, yeah. The liability protection, stockholders don't lose more than they paid for their stock. That's it. They're protected from liability for debts of the business. A Subchapter S corporation. This is entirely, as I said before, this is entirely a tax creation. A Subchapter S corporation is what's called a small business corporation. It has to be a United States company. It has to be owned by, it can't be owned by non-resident aliens in the United States. It can't have more than 100 shareholders, and it can only have one class of stock. But the payback is that an S corporation is a corporation with the benefits of a corporation in terms of limited liability, but there's no tax at the corporate level except if it used to be a C corporation, that's a garden variety corporation, and had retained earnings and profits. then those earnings and profits still get the second layer of tax. But that's because they were earned when it was a regular corporation, not an S corporation. Okay. S corporations are given this treatment. It's similar to a partnership, except that you have these particular restrictions. And another thing that's a little different from a partnership is, remember I said that in a partnership, the partners can decide what percentages they want to share taxes, profits and losses at? Well, in an S corporation, the profits and losses are passed through for tax purposes strictly according to stock ownership. So if someone owns 30% of the stock, they'll get 30%. They'll pay tax on 30% of the profits, and they'll pay tax on 30% of the losses.
Can it be a person of one?
An S corporation can be owned by a single individual, and everything then, all tax effect will be passed through to that single individual. Yes. Lineal descendants, family counts as a single stockholder. So really, if you had 100 families, you could have like 500 shareholders. But we don't count them all. The S corp avoids the double layer of tax. Again, both of these exceptions to that rule only apply if the S corporation used to be a C corporation. How do you get to be an S corporation then? How do you get to do this? Well, you file a form. I'm going to, instead of looking at the tax return for the S corp, which I think we've kind of seen enough of those. It's the same kind of thing, income, deductions. Let me go to the form that you file in order to become an S corporation. Okay, that's it. It's called an election by a small business corporation, Form 2553, and you should have a copy of one there in front of you. Right here on the form, it says, it mentions the 100 shareholders, which is a limit. You can add as many pages as you need to get everybody listed on there. It's a simple statement, really, that you elect to be taxed under Subchapter S. And there's a set of rules that aren't all that complicated. Here's the basic information called for about the company. You can see here that, people would mess up, okay? It's human. Somebody meant to file the Subchapter S election. Well, you have to file it within 3.5 months of when the corporation is formed. And if you want to be an S corporation from the beginning of the year, you have to do it between, the beginning of the year and March 15th. And people make mistakes, and they file it in the wrong place, or they forget to file it, or they ask their accountant to file it, and the accountant doesn't file it. So right here, it says, if I didn't file it, here's my excuse, IRS. There are several lines on here which are just to explain if this was not a timely made election, to explain why. And frankly, IRS has become fairly liberal on allowing late elections that aren't filed according to the rules. But here's the key thing to remember for all of these elections that can be cured, and that is you'll probably be okay as long as you do file the form eventually and have a reasonable explanation, as long as you always behaved as if you were an S corporation. So if you want to be an S corporation, file the right income tax form. It's 1120S. 1120 is the corporate return. 1120S is the subchapter S return. And that's the biggest key. Behave like what you want to be, and you'll probably be allowed to make corrections if you messed up somewhere along the way in the paperwork. The back of this form, though, is significant for this reason. You see here that the back of this form is all signature lines. That is because every single stockholder has to sign the election form. Stop and think about it. When you sign this form, it's going to mean that every stockholder is going to have to pay some share of, some tax on their share of the income, or will be passed through some share of the loss every tax year, regardless of whether this corporation pays any dividends. You can't do that to somebody unless they agree to it. So if we're all together in the ownership of a subchapter S corporation, no one person can change to an S corp and trigger that automatic annual taxability unless everyone has agreed to it. So that's why there are all those signature lines, and you add as many pages as you need to get all those signatures on there. That's how you become a subchapter S corporation. You file that form. You follow up with your accounting by keeping track of all the separately stated items, and there are fewer in a subchapter S corporation than in a partnership. Okay, let's move on. I have to go. I can learn. Okay, the Holy Grail, the limited liability company, where you get the same limited liability that corporate shareholders have, and you can be taxed as a partnership. However, again, it's a choice. A limited liability company can be a number of different things. It is what's called an eligible entity under the tax code. What that means is it's eligible to choose whether it's taxed as a corporation or as a partnership. An eligible entity can file another election form, the 8832, which you should have in your paperwork there. The 8832 is similarly, I think, just a two-page form. And once that form is filed, you will have marked on, when you file that form, you will mark on there whether you want to be taxed as a partnership or as a corporation. Now let's think about that for a minute, because I put up there another circle for the sole proprietor. The reason I did that is that the most basic requirement for being, yes, ma'am.
So the 8832, I don't think that was taxed.
Okay. Here it is. You can get it on the internet. It's called an entity classification election. It asks you whether you've already made an election, and you can only do it every 5 years. That's this 60-month limit here. If the entity has only one owner, they want certain information. It could be owned by corporations, too. I mean, a corporation can own a limited liability company. Again, everyone needs to sign. Here's where you choose. What do you want to be taxed at? You just check the box. So the most basic requirement for being a partnership is what? What do you need to have a partnership? Two people. Yes, you need partners. A person alone isn't a partner and can't be a partner. But they can make an election. A single owner limited liability company can make an election to be taxed as a partnership on this form. But when they do that, they're basically a sole proprietor. It's complete pass-through taxation. Remember, the sole proprietor just puts everything on their 1040 by putting it on a Schedule C? Well, it would be the same for the single owner of a limited liability company that has a single owner, or that elects to be taxed as a partnership. So when that election is made, the consequences could simply be that a person who elects to be taxed as a partnership could be treated as what they call a disregarded entity, which really sounds dehumanizing, as if something you don't exist. But the disregarded entity is just tax speak for a sole proprietorship, essentially. If it's an individual, I mean, the owner of a single member limited liability company might be a corporation. So that corporation would simply be treated as if the limited liability company were a division, maybe, or a branch of the company rather than a separate, complete, different entity. Okay, did I cover all this? Owners of limited liability companies have limited liability under state law. The owners are at risk only for the amount of their investment. And regardless of what tax scheme is chosen by the limited liability company, it remains a limited liability company for purposes of state law. So choosing to be taxed as a partnership for tax purposes doesn't change anything for tax law, for state law purposes. And of course, when I say state law, it's liability, okay? For liability purposes, for people who trip and fall on your premises, for creditors who want to collect from you, for customers who complain that they were injured by your product, you still have limited liability for all of that. Limited liability from, I shouldn't say, you're not liable for it. If an LLC makes no choice, okay, what if you don't file the election form and you're a limited liability company? Well, the default position is you become a partnership or a disregarded entity. And that's actually the kinder choice for the tax code, because you can get out of a partnership without triggering recognition of gain much easier than you can get out of a corporation without triggering tax effects. So it's the friendly alternative that's the default. Okay, so an eligible entity that makes an election could be a sole proprietorship or a partnership, depending on how many members it has. If it's originally a sole proprietorship and another member acquires an interest in the LLC, voila, it has become a partnership. The other choice is to be a corporation. Now, if the LLC chooses to be taxed as a corporation, and I'm not recommending it. I mean, if you want to be a corporation, you can be a corporation. You don't have to be an LLC and then make the election. But if it does choose to be taxed as a corporation, it could then take that next step and also choose to be an S corporation. Probably more complicated than it would have to be, but it's possible. And in fact, the tax code made a friendly little change there, too. If you file the election on Form 2335, that's the one to elect to be a S corporation. If you file that form and you forgot to file the 8832, IRS will just treat it as if you filed the 8832. They'll say, oh, what the heck? What's one form less? Okay, we get it. You want to be an S corp. I think we covered most of this. Again, there is no separate tax scheme for limited liability companies. Don't let anybody tell you, oh, I'm being taxed as a limited liability company. There's no such thing. It's either partnership taxation or corporate taxation, or if you're alone, sole proprietor. Yes?
Have those slides either.
Oh, okay. Yeah, there. I added some things after the handout was printed. Anybody who wants to have the additional slides, if you give me your email address, I would be glad to ship it out to you by email. If you write it down on any scrap of paper, I'll take it with me and get it out to you tonight. Again, on Form 8832, that's another situation where people make mistakes. Here also, there are some very, very, well, okay. In the IRS world, it's quite liberal to allow late elections. But again, the key is to always behave as if you were the entity that you want to choose to be. Don't take inconsistent positions on your tax forms. Any questions about that? Yes.
So if you have an LLC, partners, and we
If you're a partnership,
no, we are an LLC.
okay, you're an LLC.
So is the LLC filing its own 1040?
Oh, okay. The partnership, the LLC that chooses to be taxed as a partnership actually files a partnership return. That's the 1065. So an LLC that chooses to be taxed as a partnership files a partnership return. Yeah.
Maybe a little bit beyond tax law and tax consideration, but with the existence and prominence of LLCs today, does that render partnerships subject to S corporation? Or do people still choose to operate their business as a partnership that's subject to S corporation, still likely?
The creation of LLCs and the popularity of LLCs has made subchapter S corporations much less common as new entities. A lot of people have chosen to remain subchapter S corporations if that's what they already are, because there are tax consequences to liquidating. But you are correct that it's made subchapter S corporations much less popular. Partnerships, I would say, because of the availability of limited partners and limited liability limited partnerships, you still have a fair number of partnerships. The advantage to partnerships is it's easy to create one. You don't have to go through anything. You just start working together, and you've created a partnership. And you can get, well, same with an LLC taxed as a partnership. You can get out of that form without generating tax consequences.
Would anybody form a general partnership today?
I would say there's not. When it happens, it's usually inadvertent. People start in a business, they start working together. Someone has an auto repair shop, somebody comes in to help them out. Eventually, they're working as a partnership, and they have become a partnership sort of just in the natural course rather than through planning. Yeah.
Well, it seems to me that it could be beneficial if you've got two individuals that have LLCs and they do their own business separately, but then they also want to do some business together. So then wouldn't it make sense for a partnership to be formed by the two LLCs together?
Yeah, that could work easily. And by the way, he's pointing out that partners need not be human beings. A partner might be an entity, as you're pointing out. Two LLCs can form a partnership, where each LLC is a partner in the partnership. You would have, if I had a blackboard, I would draw it, but you would have a double pass-through. The operation of the partnership would generate income that is passed through in tax effect to each of these LLCs, and then each of those LLCs in turn would file forms that allocate the income or loss to their owners. Yes?
Okay, I didn't like all the tax work with a partnership. Could two LLCs form a third LLC together?
Yes.
Okay.
But that's not going to escape partnership accounting if you want it to be taxed as a partnership.
Partnerships.
Yeah. Yes.
So, if you're currently a C corporation, can you convert to an LLC?
It is possible to do a conversion, but the tax effect is the same as if you liquidated the corporation and then reformed as a partnership. The IRS would, even though under state law you can file something with the Secretary of State doing an entity conversion, in the eyes of the IRS, what you have really done for tax effects is you have distributed to the owners of the corporation all the assets of the corporation. The corporation will recognize and pay tax on any gain inherent in that property, and the stockholders will pay tax as if they were receiving a dividend. And then after all of this, after this transaction takes place and the tax consequences are all shaken out, then the stockholders take the property that was distributed to them by the corporation and contribute it to a partnership and form a new partnership by forming an LLC. None of those things are what's actually happening in real life, but that is how it would be treated for tax purposes. It might be there aren't any gains inherent in the corporation and that you could do this without really triggering any tax liability. But you'd have to walk through it. Before you do it, you would want to have it all planned out, and you would have all the numbers worked out to know whether you're going to trigger a tax liability or not. It's planning. Yes?
I have a question. If you're a sole owner of limited liability, and you move to another state, restart, and are there tax?
You don't have to close and restart, and there are no tax penalties for doing that. There are many LLCs and even limited partnerships and corporations formed in Delaware that are doing business all over the country. Yeah, why Delaware? Delaware has certain laws for organizations that, for a larger company, are very friendly. But you still have to pay tax in the state where you're doing business. So if you're an Ohio corporation and you end up in business in Indiana, then you're going to pay tax in Indiana. Ohio imposes a tax on the business done in the state. No. I mean, you'd be called a foreign business entity in Indiana. If you're an Ohio corporation, you'd be called a foreign business entity. You register with the Secretary of State. You're licensed to do business in the state, and it's really not an issue. Yes.
In answering my prior question, you referenced limited partnerships. Do people form limited partnerships today?
I haven't formed a limited partnership in over 15 years for a client. I just recently came across a limited partnership. It was a oil and gas company that was a Delaware limited partnership doing business in Ohio. I have no idea why. I don't know how long it's been in that form. I don't know. But no, it's uncommon today for me to advise a company to form a new enterprise as a limited partnership. Okay. The commercial activity tax in Ohio. This is what used to be our state corporate franchise tax. A company with $150,000, less than $150,000 of gross receipts is exempt. Doesn't have to pay the corporate activity tax in Ohio at all.
So have to file them correctly?
Not if you're exempt. Over $150,000, then you pay the minimum of $150 a year. Up to $1 million in gross receipts. It goes as high as $2,600 on gross receipts over $4 million. Is this not in your? Oh, okay. I was going to say you can just read it as well as I can, but you'll have to give me your email address. Gross receipts. What are gross receipts? That's your gross revenues, but minus the returned goods or bad debts. Bad debts can be subtracted from gross receipts. And you only have bad debts, by the way, if you're on the accrual basis of accounting, because if you're on the cash basis, then you never have accrued anything to write off as a bad debt. The commercial activity tax is supposed to be paid with quarterly filings, but if you fall in the $150,000, if you fall in the minimum range between $150,000 and $1 million in gross receipts, then you're supposed to just file once at the beginning of the year by May 10th and pay the $150. We went through the example of double taxation. Okay. All right. Well, my goal was to have you understand the various forms that are possible for doing business and to see how those affect your personal tax return and for you to understand the elections that are available for taxation of businesses. So we still have 15 minutes left. I'm open for any questions. Yes.
On an S corp, you
Yeah.
talked about the taxation flow through.
Yes.
Okay, but how about for local taxes? Because I have an S corp.
That's a really good question.
Local taxes, I still have to pay on the S corp.
Ohio has a law that they will follow the federal scheme for LLCs and for S corps. So in Ohio, if you have an S corporation, then, as we already walked through, well, we didn't. Maybe I should go back and do that. I had a 1120S. Uh-oh. I don't have the 1120S on here.
Yeah, you do. Go up higher.
That's the 1120. The 1120 is a corporate tax return, not an S corp tax return. Okay. The concept, though, is the same K1 concept. A K1, similar to your partnership K1, which I put back up on the screen. A K1 is generated to go with an S corporation tax return. The K1 shows how many shares of stock you own in the S corporation. That's all you need to know is what a number of how many shares there are and how many you own. And that's all you need to know in order to figure out what percentage of the income should be taxed to you, because it goes only according to stock ownership. So if you own 25 of the 100 shares of stock that are outstanding in that corporation, then the K1 is going to record that fact and then report to you what 25% of the profits are, what 25% of the capital gains are, or what 25% of the depreciation deductions are. And that is what you will then transfer from the K1 to your Form 1040. Now, Ohio's income tax respects that and does not impose a separate tax on the S corp. Ohio doesn't tax the S corp. Instead, Ohio's starting point on the Ohio income tax return is your federal adjusted gross income. So back to the good old 1040. Your adjusted gross income is figured on the front of your 1040. It's this line right down here, line 37. And that line 37 is what you put on line 1 of your state tax return, and it already includes from one of those lines up there the amount that was passed through to you from your 10K.
Okay, but now I'm also talking about the local taxes.
There it is. Line 17 has income from S corps. Here it is. So that's how it gets on your Ohio tax return.
Okay, I understand each federal and Ohio.
Okay.
But then I also, seems like I have to pay every year on the S corp for a local tax. I live in Twinsburg, we have Rita.
I'm sorry, you meant, okay,
And
yeah.
You know, and I'm paying Rita tax on the S corp as well as, you know, my dividends and earnings from the S corp.
Really?
On my 1040.
Wow.
And I just want to know if it's pass-through taxation, why is that occurring? Or why do I have to pay local tax?
Wow. That's not, I don't have an answer for you. This is Twinsburg?
Twinsburg
Boy, am I going to look this up.
is under Rita regional income tax.
Uh-huh. Yeah. I see what you're saying, and I'm very interested in looking at that. Maybe I have some clients that I could represent against that scheme of taxation.
I talked to my, you know, accountant, who's also a tax attorney,
Mm-hmm.
and he just says that's how Rita works.
Yeah, yeah. Well, and it's true. The states and local taxing subdivisions don't have to follow federal law. They can impose their own tax. But I'd want to look at that.
Seems like I'm paying twice on that.
I know what you mean. Yeah. If the dividends are already included in your income, then you're paying that. And now if they're imposing a tax on the subchapter S corporation, you're back to having a double layer of tax.
Is that considered earned income though?
Pardon?
Is that considered earned income?
Well, it depends on what the local tax, what the base for the local tax is. If it's, well, he's referring to a tax on the S corp. I don't know if it's measured by income or not. Remember, a tax can be based on a number of different measures. I mean, it could be gross receipts, it could be net income, it could be value of property, it could be volume of business done during the year. The imagination has no limit on what could be made subject to a tax, unfortunately.
I need to look at that and see exactly what they're basing it off of. If it's, you know, actually just my net profits to the S corp, or if it's for my gross. I don't know. I have to take a look at that. But good point.
Yeah. Yes, ma'am.
So, I just want to make sure I understand correctly. If you're a single owner LLC, you said that you should file this election form and pick a partnership, and then just put on your Schedule C your income.
That's exactly right. You did get it straight. Yes. If you're a single owner LLC, you will file you still will file a partnership return. No, you don't have to, though. You don't have to, though. In fact, there were just recently the regulations were made explicit that if you're a single owner LLC, you can just do it all on a Schedule C. Yeah. So you keep track of all your business income and deductions, put it on the Schedule C, file it with your 1040, and you're good to go. Any other questions? Yes.
Out of the LLC partnerships, S corporations, how do you determine which is your best outside of the partnership? Your tax implications?
One of the things is that in a partnership, one of the advantages is the pass-through of losses, really. And if you have another source of income and you're starting up a new business that is probably going to have losses in the first few years, do a partnership, let the losses pass through to you, and use them to shelter your other income. You know, if you're starting something up on the side and you're going to have losses, but you've got another job, you can shelter income by generating the losses. I would never tell anybody, though, to forego the limited liability. So I'm saying be a partnership for tax purposes, but for state law protection of liability, the LLC is really the way to go. It's more flexible than an S corporation, but truthfully, an S corporation can be simpler. So you could probably save on accounting costs by having an S corporation, as long as, you know, if someone's inclined to do some of the bookkeeping themselves, maybe that's a better way to go. Partnership accounting is a specialized area.
Now, with the S corporation, the LLC, are they pretty much basically the same legal protection if someone gets hurt?
Yes.
To get your personal.
Yes, they have the same protection from liability. Sir.
What's the best way to document car usage?
To document what?
Car usage and mileage versus...
Oh, keep a written log in your car. Write down the odometer reading at the beginning of your business travel and at the end of your business travel, and date it.
Do you need to write what you were doing that day? Or?
And write down where you went and why. It's a pain in the neck.
And if you
But
don't have it, is it considered 100% personal then? Oh.
If you can't substantiate it with something other than your word, then they won't allow it. And the tax court won't either. I had a jury trial on, not a jury trial, I had a tax court trial on substantiation of certain business activities. In that case, it was the operation of real estate. And that's one topic that I had on my outline that was published that we never got to tonight. I actually have 10 copies with me of something that would be useful for people who own rental real estate. If anybody's interested in that, let me know. Yeah, if there are special rules for what they call real estate professionals. You need to do, the reason, what made me think of it is his question about documentation. Your documentation of your activities is everything. That is so important. If you are ever audited, you need to have a calendar where you've written down what you did at each location that you operate. Now, if you only have one rental apartment or something like that, that's easy. But you should still document what you've done. You know, what did you go and fix yourself? When did you meet the plumber over there? When did you repaint because somebody moved out and you needed to get it ready for a new tenant? Bookkeeping is key. And see me, and I'll give you a copy of this article.
She has a business and she has her sign, on her vehicle.
You know, the cost of the sign and putting it on there would be deductible, but I don't think it translates to mileage. I don't think you can say that miles driven should be deductible as an advertising expense. Darn. Yeah.
In regards to the mileage, what if
Well, you might get away with it.
like I went from here to here, like I know exactly where I went, I just wrote down how many miles.
Okay. Well, no, that, yeah. If every time you go to your supplier, it's a 30-mile round trip. And you've written down the visits that you made to the supplier, that's probably good enough. they, if you read the IRS rules, though, they will tell you to write down your beginning and ending mileage. Yes.
I have my truck's registered as
If it's available for personal use, then you should keep track of it, yes.
what if that fuel fleet card did?
Yes, you should do that.
Is that still okay to have that printout to?
I'm sorry, maybe I'm not getting your question.
Gas card that I have at enter mileage.
But that's not saying how far you've driven for business purposes.
Well, it's starting to ending of mileage. Track that using that.
Wait a minute. You're talking about the mileage when you buy the gas?
Yeah.
No, I don't think that works. I mean, that doesn't document that this trip from here to here was for business purposes. Okay, well, our time is finished. It was a pleasure. Thank you very much. You're welcome. Thank you.